The market opening is here and it's absolutely quiet. The Nifty is now at 17,900. As far as the markets are concerned, extremely volatile. They've been choppy since we started the trading session.
The Nifty, after the initial 1.5 odd hours, not very much has happened.
The Nifty ends a little in the red, so we're down close to around 20 points odd. The problem today was Bharti Airtel, post that downgrade coming in from JP Morgan. It goes home with a cut of around 3.5%, and select pharma names and pharma-facing stocks, they got hit.
Hello and welcome to CNBC-TV18. You're watching Markets Today, the show where we track about 6 hours of the day's trading action in 5 headlines. I'm Sonal Bhutra. Here are the headlines for the day. Stock markets end range-bound session with marginal losses. Bank stocks buck the trend while pharma stocks drag. The Defence Acquisition Committee approves procurement of an additional 4,276 crore rupees worth of missile systems for the Army and Navy. The news helps vendors like Bharat Dynamics, BEL and Astra Micro to gain a percent. Restocking ahead of the Chinese New Year gives metals a further fillip as a V-shaped recovery buoys sentiment further. The optimism on demand outlook boosts metal stocks. Telecom stocks sulk as JP Morgan flags uncertainty of tariff hikes in 2023 as a negative for the sector. The brokerage also downgrades Bharti Airtel, pushing the stock 4% lower. However, the IT sector perks up after JP Morgan says the street expects better margins and lower attrition going forward. Adani Wilmar surges on healthy volume growth across segments in the third quarter. Sun Pharma receives a US FDA warning letter for its Halol facility, while CNBC-TV18 learns that Aurobindo Pharma's plant in Telangana is under inspection by the US drug regulator. Well, those are the top headlines that we are tracking today. But as always, let's begin with the action from Dalal Street. A range-bound session saw the market end flat with a slight negative bias. Mid-caps underperformed the benchmarks to close 0.25% lower. However, banks were the star performers, with that index soaring 0.5%. Metals led from the front, while pharma dragged. Prashant Nair is here with the wrap of all the trading action today. Prashant.
It was a small change in terms of close on the index, the Nifty, that is 20-30 points lower. There was a fair bit of volatility, but it was early on in the session and within the first 2 hours of trade. And after that, the market just kind of stalled, did nothing, and ended in exactly that fashion by 3:30 as well. Banks, which had been underperforming for the last couple of days, outperformed today. Let's see if this is just a one-day phenomenon or there is more. Bharti was the big loser in the Nifty, and that kind of weighed. The stock was down about 4% by close. Cipla, Divi's Laboratories were some of the others which actually lost. Metals as a pack did well. So Hindalco, there was BPCL, Sun Pharma. These are some of the names which actually did well. In the broader markets, advance decline was broadly 1:1. Actually, by close, it was more advances as compared to declines by about 150 odd stocks. So having said that, let me start with what did well in the broader space, and it was a long list. Tata Communication, names like NMDC, PTC, Marksons Pharma, Tata Investment Corporation, Greaves Cotton. We had that management of Greaves Cotton out of the Auto Expo earlier today. Sterling Tools, Nazara, Rate Gain were some of the others which did quite well. Broader market losses coming through in Varun Beverages, and lots of well-traded large liquid names trading down on volumes today. Adani Transmission, SRF, Sona Comstar, MRF, Laurus Laboratories were a few which I think deserve some mention. What next? I think in terms of just level watching, 17,774 is the weekly swing low, which was made on the 26th of December. The Nifty today came within 50 points of it and then bounced. I think it's absolutely important that that level holds in the face of any selling in the coming days. And in terms of global cues, I think any real action will only pick up once we get the US consumer price inflation numbers, but that is only tomorrow. So I think it'll be Friday morning to get a sense of how global markets react and what our markets will do as well. Back to you.
Prashant, thank you so much for joining us with that analysis on the market moves today. Moving on to market opinion now, Ashwini Agrawal of Demeter Advisors says that the Indian market has been expensive compared to other EMs, adds that he remains positive on the banking space. Listen in.
I think some amount of rebalancing is happening because India, in the regional context or in the emerging market context, I dare say even in the global context, has been very expensive for a while, and therefore some rebalancing appears to be taking place. But like you said, it's a very, very short period, just a few days of trading, and we have to see how this evolves. I think on the institutional flows part, I think 2023 will be a challenging year, both for domestic as well as for international flows, is my sense. I've been very positive on the banking space. I continue to be positive. I think there is some fear of NIM compression as cost of fund increases. But my sense is that on the credit cost side, we are going to see positive surprises. So I still see earnings from the banking sector to be quite robust.
All right, that's the second, that is the expert opinion that is coming in. But moving on to the second headline now, the Defence Acquisition Committee has approved the procurement of an additional 4,276 crore rupees worth of missile systems for the Army and the Navy. The news helped vendors like Bharat Dynamics, BEL and Astra Micro gain 1%. Vaishta is standing by with more details and what it means for the stocks. Vaishta.
Well, not just Bharat Dynamics, but also other defense stocks are doing well in trade today. This is because, like you mentioned, the Defence Acquisition Council has approved the acceptance of necessity, and this is for 3 capital acquisition proposals summing to approximately 4,300 crores, and the 3 proposals include 2 of the Indian Army and 1 is of the Indian Navy. Now, this includes the procurement of Helena anti-tank guided missiles for launchers and for associated support equipment, which will be integrated to the Advanced Light Helicopter. Also, there is a procurement of IR homing missile system under the design and development by the Defence Research and the Development Organization. So all these new developments are expected to benefit the aerospace and the defence manufacturing industry, which includes players such as Bharat Dynamics. Back to you.
That's right, Vaishta. Thank you so much for those details. Defense sector has been in focus of late. Moving on to the third headline now. Strong demand outlook as China restocks ahead of its new year in the face of tightening inventories have pushed metal prices higher. This has helped metal stocks continue their momentum. They have been gaining in the last couple of trading sessions. Manisha Gupta is standing by with the latest from the metal space. Manisha.
It's been a strong day for metals as we look at copper prices trading at a 6-month highs, not just on LME but Shanghai and the US markets as well. We also are looking at strong cues continuing in case of aluminum and zinc. The overnight markets did see 1 to 2.5% of gains, and for this year until now you have zinc prices which are up 6.5%, copper is up 4.5%, aluminum is up 4% as well. So strong start to 2023. Copper clearly essentially continues to be a favorite among all metals, where we are looking at the smelting activities in 2022, the lowest in 6 years. Also, the political unrest in South America, which is Chile and Peru, have led to lower production in case of copper. Markets do anticipate that the first half could see consolidation and gains, but the major gains could really come in for the second half when you would look at the interest rate peaking out, China reopening, having a strong on-ground demand coming back into the market, and EV as a segment looking at strong demand as well. As of now, the markets do believe that the strong rationing that we are seeing within Europe and the demand coming back will also continue to support many of these metal prices. If you look at the last 4 or 5 years, we've seen copper prices continue to gain since 2019. 2022 was a bit of blip by 13% of a decline, but this year yet again most of the metal prices are trading in the positive. The overall LME warehouse stock is the lowest in 25 years, with zinc inventories having declined by nearly 84%. Copper inventories have seen a constant decline. Aluminum inventories fell by more than 70% as well in the previous year. So we are entering 2023 with a bit of a deficit, and that is also supportive into the markets. What the street will now watch out for is the US inflation data, and ahead of that, because of the weakness in US dollar index, there is some support that continues into this space.
Manisha, thank you so much for telling us what's happening as far as the metal space is concerned. So let's take that theme forward, because steel companies are also in focus after JP Morgan said in its latest note that more steel price hikes are on the way. Nigel D'Souza is joining us with details of that note. Nigel.
Well, that's right. JP Morgan believes there are more price hikes that are likely to come about. They highlight the fact that Chinese prices, well, that had moved to closer to around $500 per ton. That's bounced back in style to around $620 per ton. And some deals are also happening at around $635 per ton. They believe that demand is likely to bounce back post the new year. Remember the price increases. Normally, it's a seasonally strong period, that November, December odd period. But this time around, it's got a little bit delayed. But they believe the best is yet to come in terms of pricing. They highlight that, yes, domestic prices are up by close to around 1,500 rupees per ton. But now the landed imported steel is coming in at around 60,000 rupees per ton. while the domestic pricing is at around 56,000 rupees per ton. So they see a good case that pricing can go up. Steel prices can move up by around 3,000 rupees per ton in the next 2 to around 3 months odd. They also take on board that, yes, coking coal costs are higher, which could limit the margin expansion from here on, but they're expecting good earnings recovery for the steel stock. So that could explain why the stocks do well.
All right, that's all about the metal space. Nigel, thank you so much for joining us. And with that, we'll slip into a break now. But stay tuned, we'll be back in a bit with all the other headlines that we are tracking today. Welcome back. You're still tuned into Markets Today on CNBC-TV18. Let's go to the rest of the headlines that we are tracking for you now. The fourth headline now. Telecom stocks sulled in trade today as JP Morgan flagged uncertainty of tariff hikes in 2023 as a negative for the sector. The brokerage has also said that lack of tariff hikes could lead to a de-rating. Reema Tendulkar is standing by with the details of this note. Reema.
Thanks so much for that. You know, the elephant in the room when it comes to the telecom sector and its performance is going to be whether we are going to see a tariff hike in this year. And according to JP Morgan, there is no tariff hike coming in from the telecom operators this year. It is pre-election, inflation is hurting consumers, and they're saying it will be difficult for telecom operators to do another tariff hike because the previous tariff hike of 20% had resulted in heightened churn. Even last year, there was a lot of hope that telecom operators will do a tariff hike, but that got pushed back as Bharti Airtel and Reliance Jio decided to focus on their 5G rollout in order to get the first mover advantage. And even this year, in calendar year 2023, both Bharti and Reliance Jio are going to be focused on rolling out 5G services and expanding their coverage. Now, when it comes to 5G pricing, right, 5G can command premium pricing over 4G, but according to JP Morgan, that's not going to happen anytime soon. Right now, at least, both the telcos have offered 5G on the existing 4G plan pack, and they say there is no premium pricing for 5G, at least till there is a critical mass adoption. And if there is no tariff hike which comes through in the next 6 months, it could come in as a big disappointment and Bharti Airtel stock can derail. In the event that we do see a tariff hike, according to JP Morgan, the quantum remains uncertain. Back to you.
All right, Reema, thank you so much for all those details. In fact, let's continue with this theme. JP Morgan also downgraded Bharti Airtel, pushing the stock 4% lower in trade today. The brokerage maintained that high capex, price repair delay and lack of 5G monetization can halt industry returns. Nimesh Shah is here with more details on this one. Nimesh.
That's right, and that's the reason why Bharti is the biggest loser today, as JP Morgan has today downgraded the stock to underweight from overweight, and they've sharply cut the target price to 710 versus 860 earlier. Now, three specific reasons why why JP Morgan has downgraded Bharti Airtel today. One, higher than expected capex. Two, delayed price repair, and three, lack of 5G monetization. In fact, JP Morgan believes that Jio's focus on high-end consumers would mean that there is a higher capex for Bharti Airtel to defend the market share, and competitive pricing in 5G would delay the free cash flow and return on invested capital. Now, at the current market price, JP Morgan believes that the stock is baking in a modest FY24 estimated capex, 10% tariff hike, and a continued ROIC expansion. All three looks difficult in the current environment, and hence a big downgrade on Bharti Airtel to underweight from overweight, and they've sharply cut the target price now to 710.
Okay, Nimesh, thank you so much for those details. So that's all about the telecom sector. And let's stick with Bharti Airtel now. Ashwini Agrawal of D-Meter Advisors says that the stock has no pricing pressure concerns as of now. Listen in.
It doesn't appear to me to be very logical to say that there will be intense price competition between these two players for market share, which is harmful for both of them. So let's see how it evolves. I mean, historically, that what we've seen anywhere else in the world, and even in India, if you just think about what's happened over the last year and a half, is that pricing competition tends to be a little reduced when you have just 2 players or 3 players competing for market share. So I don't share the concern on pricing pressure right now.
Right, from telecom, let's move on to the IT space. The IT sector perked up after JP Morgan released its estimates suggesting that Street expects better margins and lower attrition going forward. Reema is joining us with all those details. The IT pack did really well in trade today.
Thanks so much for that. So the IT sector is doing well today. And one point that we would like to highlight is that even though the revenue growth for IT companies will moderate in FY24 and FY25 to high single digits, given the macro uncertainty, tighter technology budgets, clients being under stress, the EPS growth for the large cap IT companies is still going to be in double digits for FY24 and FY25. The JP Morgan estimates for the EPS growth for the top 5 IT companies are on your screen, and you would see it ranges from between 10% going up to even 18%. And remember, ultimately valuation is a function of the EPS, of the earnings growth, and here earnings growth will still be in double digit. The reason for why, despite revenue growth being in 6 to 8%, why will we see a bottom line growth much faster? And that's because margins are expanding on the back of easing supply side situation. Attrition, according to TCS, has come down by 600 basis points on a quarterly annualized basis. Subcontracting costs will start to decline, so margins are going to be supportive, which will drive an EPS growth of double digit for the IT companies.
Okay, all right, Reema, thank you so much for all that. Moving on to the fifth headline today, Adani Wilmar gained 2% today on the back of a healthy volume growth across segments in the third quarter. The company says that growth has been broad-based across both urban and rural towns. Mangal Malu is here with the fine print on the company's business update for quarter 3.
It's a decent update coming in from Adani Wilmar. In fact, for the third quarter, the overall revenues of the company grew in high single digits. The mainstay of the company, the edible oil business, actually showed high single-digit volume growth, but because of the oil prices declining after a big rally that we saw in them, last year, we've seen the company pass on those prices, as a result of which the revenue growth has been low single-digit itself. Importantly, the food and FMCG business of the company, which is going to be the margin driver for them, has actually grown in mid-40s as far as revenues are concerned, and about 20% in terms of volumes as well. The industrial chemicals of the company also showed high teens sort of growth. The management has said that the demand was extremely strong on account of festive season, has indicated that both the rural and urban areas of the company have been doing well, but urban saliency has been higher. For the oil business, if you strip off the weakness in industrial demand, the consumer demand has been extremely strong, and out there too, revenues have been in double digit, as a result of which the stock ended higher in today's trading session.
All right, that's Adani Wilmar for you. Let's move on to the pharma space now. Aurobindo Pharma was in focus today after CNBC-TV18 learned that the company's plant in Telangana is under inspection by the US FDA. Let's get in Ekta to tell us more about this.
Well, yes, Aurobindo was in focus today. I do understand from my sources that the Judge Chedlar unit, which is basically in Andhra Pradesh, is getting inspected by the US drug regulator. The inspection is expected to have begun this week and is expected to be a normal inspection or routine, considering that this plant was last inspected around 3 to 4 years ago. It is around 2 to 3% of total sales for the company. It manufactures oral solid dosages and does not have any kind of compliance issues at this point in time. So important to track. In the next couple of days, we will get an indication in terms of how this particular inspection has panned out. We did reach out to the management. They do not have a comment on the story.
Okay, so Ekta, we will actually ask you to hold on because Sun Pharma is also in focus after the US FDA issued a warning letter to the pharma company's Halol facility. Tell us more on this one.
Well, yes, Sun Pharma was in focus today on the back of a couple of news pieces. One was the warning letter which was issued to their Halol manufacturing facility has now become public. It was uploaded on the US FDA site. A couple of key important takeaways from that was the US FDA indicating that the firm failed to establish and follow appropriate written procedures. There was a failure to thoroughly investigate any discrepancy or failure of a batch. Failure to clean, maintain, sanitize, sterilize equipment, which is basically important for drug manufacturing. The US FDA has pointed out ineffective quality systems, and a CGMP or a third-party consultant is recommended. Remember that this is largely in line with expectations because Sun Pharma had communicated that the Halol plant was placed under an import alert on the 7th of December by the US FDA, and they were subsequently issued a warning letter on the 15th of December for this particular facility. Separately, we did have brokerage notes on Sun Pharma as well. Jefferies, for example, wrote on Sun, they believe that the overall domestic formulation and CRO, CDMO space have structural growth drivers. They believe generics is a tactical play. According to them, their top picks include Sun Pharma with a target price of 1,200 rupees and Syngene with a target price of 750 rupees. IIFL also upgraded Sun to buy. According to them, it is one of their top large cap picks of 2023.
All right, that is all about the pharma space. Ekta, thank you so much for joining us with that. Meanwhile, sources told CNBC-TV18 that all marketing companies, they're hoping for 50,000 crore rupees as cash compensation from the government to make up for losses after fuel prices were frozen. Sapna Das is here with the exclusive details. Remember, the stocks of all marketing companies were buzzing in trade today. Sapna.
Well, industry players have estimated a cash compensation requirement of 50,000 crores from the government, as an immediate measure to help them make up for the losses that they've incurred on petrol and diesel in H1, Q3 also probably, and of course Q4 is ongoing. But 50,000 crores is their rough estimate in terms of the losses that they've incurred in terms of marketing of these products. That's one. The second viewpoint that's coming from OMCs very clearly is the fact that they just only can't manage to keep their head above the water and just be in a survival mode forever. Either the compensation should come through in terms of fiscal support from the government, cash fiscal support from the government, or they should be allowed to raise prices. For example, 2 to 3 rupees, price raise on diesel will help them go a long way. So these are the two demands, key takeaways from our conversations with OMCs at various points in time. This has been an important issue. It has been doing the rounds for quite some time. The government has compensated OMCs to around 22,000 crores for the LPG losses. Will they be willing to do the same for petrol and diesel losses also? That's a bit of a question mark. The matter is not closed yet, and we just have to keep a watch as to how much of this money actually comes through from the government coffers.
Okay, all right. So these stocks in focus, of course, this would be a big boost if it actually comes through for all marketing companies. But with that, we'll take your leave on this edition of Markets Today. Thank you for watching.
Presented by Tested Like Samsung.